Preparing for a financial analyst at Costco interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Costco? Costco appeals to me because its financial performance is driven by a distinctive membership model, disciplined pricing, and operational execution. As an analyst, I would enjoy connecting warehouse-level trends, renewal rates, traffic, basket size, and expenses to broader business decisions. I also value the company's long-term orientation and emphasis on integrity. My goal would be to produce accurate, practical analysis that helps leaders allocate resources, protect value, and improve the member experience. While answering, connect Costco's membership model, disciplined cost culture, strong customer loyalty, and operational scale with your analytical interests, emphasizing how your skills would support decisions rather than simply describing the company as successful. Question 2. Walk me through the financial statements and how they connect. I start with the income statement, which shows revenue, expenses, and net income over a period. Net income flows into retained earnings on the balance sheet and begins the operating section of the cash flow statement. The balance sheet captures assets, liabilities, and equity at a point in time. Changes in working capital explain differences between earnings and operating cash flow, while capital expenditures and financing activities complete the cash flow bridge. Together, the statements show profitability, financial position, and cash generation. Make sure to cover the income statement, balance sheet, and cash flow statement, explaining how net income flows into equity and operating cash flow, while working capital and investing activity reconcile profitability to liquidity. Question 3. How would you analyze Costco's revenue growth? I would decompose growth into comparable sales, new warehouse contribution, membership fee revenue, foreign exchange, and fuel-related effects. For comparable sales, I would separate traffic from average ticket and examine product categories, geography, and timing. I would also compare reported growth with constant currency growth and assess whether gains came from volume, pricing, or mix. Finally, I would link the analysis to gross margin, renewal trends, and forward guidance to judge sustainability rather than focusing only on the headline percentage. In your answer, separate comparable sales, new warehouse openings, foreign exchange, fuel prices, membership fees, traffic, average ticket, and product mix. Then explain how you would distinguish sustainable operating growth from temporary or accounting-driven effects. Question 4. What makes Costco's membership model financially attractive? The membership model creates recurring, relatively high-margin fee revenue and encourages customers to consolidate purchases at Costco. High renewal rates indicate strong perceived value, lowering the need to replace customers continually. Membership also supports a low-price strategy because Costco can operate with thinner merchandise margins while earning additional economics from fees and volume. I would monitor membership growth, renewal rates, household penetration, and spending per member to evaluate both current profitability and future customer lifetime value. Be sure to mention recurring membership fees, renewal rates, customer retention, low acquisition costs, purchasing frequency, data benefits, and the model's ability to support low merchandise margins while generating attractive overall economics. Question 5. How would you forecast Costco's membership fee revenue? I would begin with the existing membership base, then forecast new sign-ups, renewals, and cancellations by region and membership tier. I would separately model Gold Star and Executive members because fee levels and spending patterns differ. The forecast would incorporate renewal rate assumptions, warehouse openings, planned fee changes, and seasonality. I would build base, upside, and downside cases, then compare the implied revenue with historical trends and operating indicators such as traffic and member spending. Focus on beginning memberships, new additions, churn, renewal rates, executive membership penetration, fee increases, geography, and timing. Explain assumptions clearly and include scenario analysis for membership growth and retention. Question 6. Explain comparable store sales and why they matter for Costco. Comparable store sales measure revenue growth from warehouses operating during comparable periods, helping isolate underlying demand from expansion. For Costco, the metric is important because it reflects member traffic, basket size, pricing, and merchandising execution across the existing base. I would examine reported and adjusted results separately, since gasoline prices and foreign exchange can distort comparisons. Calendar shifts, inflation, and unusual prior year periods also matter, so I would interpret the metric alongside traffic, units, and average transaction value. Make sure to define comparable sales, discuss the usual exclusion period for newly opened warehouses, and explain why the metric helps isolate underlying member demand while still requiring context around fuel, foreign exchange, inflation, and calendar effects. Question 7. How would you analyze gross margin at a warehouse retailer? I would bridge gross margin by product category and identify the effects of pricing, cost inflation, vendor negotiations, freight, shrink, and mix. Costco's low price positioning means a margin decline may reflect a deliberate value investment rather than weak execution. I would therefore examine sales volume, traffic, market share, and membership trends alongside margin. Fuel and ancillary businesses should be separated because they can have distinct economics. The key question is whether margin changes improve long-term member value and total profitability. In your answer, discuss merchandise mix, pricing, vendor terms, freight, shrink, fuel, inflation, private label, promotions, and membership economics, distinguishing deliberate investment in value from unfavorable cost pressure or execution problems. Question 8. What is working capital, and how would you assess Costco's working capital? Working capital reflects the resources tied up in day-to-day operations, especially inventory, receivables, and payables. For Costco, I would focus on inventory turns, days inventory outstanding, days payable, and operating cash flow. A retailer with rapid sell-through and strong supplier terms may generate cash before paying vendors, producing efficient or even negative operating working capital. I would still investigate stockouts, aging inventory, payment changes, and supplier concentration to determine whether the cash benefit is sustainable. Cover inventory, accounts payable, receivables, operating cash flow, inventory turns, days payable, supplier relationships, and the effect of rapid inventory movement. Avoid assuming that negative working capital is automatically unfavorable. Question 9. How would you evaluate inventory performance at Costco? I would analyze inventory by category, warehouse, and season using turns, days on hand, sell-through, in-stock rates, markdowns, and shrink. High turns are generally positive, but excessive leanness can create stockouts and damage member trust. I would compare inventory growth with sales growth and assess whether seasonal or imported goods require additional buffer. I would also review purchase commitments, aged inventory, and gross margin return on inventory investment to connect operational efficiency with financial outcomes. Be sure to mention inventory turns, days on hand, markdowns, shrink, in-stock rates, seasonal buildup, purchase commitments, and category-level analysis, balancing availability and member satisfaction against excess inventory risk. Question 10. How do you build a three-statement financial model? I build the model from operating assumptions, beginning with sales drivers, membership revenue, margins, expenses, working capital, capital expenditures, and financing. Supporting schedules calculate depreciation, inventory, payables, debt, and cash, which then flow into the three statements. I include balance checks, cash reconciliation, and clearly labeled assumptions. After completing the base case, I test sensitivities such as comparable sales, membership renewals, margin, and warehouse openings to understand the model's key risks. Explain assumptions, operating drivers, schedules, statement linkages, checks, and sensitivity analysis. Mention revenue, margins, working capital, capital expenditures, debt, cash, and the importance of avoiding unsupported plug values. Question 11. Which financial metrics would you monitor for Costco? I would monitor comparable sales, traffic, average ticket, membership growth, renewal rates, and executive membership penetration. For profitability, I would track gross margin, SG&A as a percentage of sales, operating income, and warehouse productivity. Cash metrics would include inventory turns, operating cash flow, capital expenditures, and free cash flow. I would avoid viewing any metric in isolation. For example, lower margin may be acceptable if traffic, membership economics, and long-term cash generation are improving. Discuss comparable sales, traffic, average ticket, membership growth and renewal, executive penetration, gross margin, SG&A leverage, inventory turns, operating cash flow, free cash flow, and warehouse productivity. Question 12. How would you analyze a proposed new Costco warehouse? I would estimate the warehouse's addressable market, membership potential, traffic, average ticket, sales ramp, and category mix. The investment case would include land or lease costs, construction, inventory, labor, pre-opening expenses, logistics, and maintenance capital. I would assess cannibalization of nearby locations and the incremental effect on membership revenue. Finally, I would calculate operating profit, cash flow, payback, and returns under base, downside, and upside cases, including slower ramp or weaker renewal assumptions. In your answer, cover demand, trade area, cannibalization, membership potential, construction and pre-opening costs, sales ramp, margins, labor, logistics, payback, and scenario testing for slower growth or weaker renewal rates. Question 13. What is free cash flow, and why is it important? Free cash flow is generally operating cash flow minus capital expenditures, representing cash available after funding the asset base. It matters because Costco must balance warehouse expansion, technology, maintenance, dividends, and potential capital returns. I would examine whether cash generation is supported by earnings and efficient working capital rather than temporary vendor timing or inventory reductions. Strong free cash flow gives management flexibility, but I would distinguish recurring maintenance needs from discretionary growth investment before assessing distributable cash. Define free cash flow as operating cash flow less capital expenditures, then discuss warehouse expansion, maintenance spending, working capital, dividends, buybacks, debt capacity, and why cash conversion matters beyond reported earnings. Question 14. How would inflation affect Costco's financial results? Inflation can lift reported sales while pressuring product costs, wages, freight, utilities, and occupancy. Costco may pass through some costs, but it must protect its value proposition, so pricing actions could compress merchandise margins or reduce units. I would separate price, volume, and mix, then examine traffic, basket size, and real purchasing behavior. I would also consider inventory timing, fuel volatility, and whether membership renewals remain resilient, since those factors determine the broader effect on profitability. Make sure to cover selling prices, unit volumes, product costs, wages, freight, fuel, consumer trade down, inventory timing, margins, and the distinction between nominal growth and real growth, including Costco's ability to protect value perception. Question 15. How would rising interest rates affect your analysis of Costco? Higher rates can increase borrowing costs, raise the discount rate used in valuation, and reduce the present value of future cash flows. For Costco, the direct debt impact may be less important than potential effects on consumer spending, housing-related demand, and market multiples. Cash balances may earn more interest, partially offsetting pressure. I would update interest expense, investment income, WACC, and valuation sensitivities, while separately analyzing whether traffic, basket size, or membership renewals weaken. Discuss discount rates, valuation, borrowing costs, consumer behavior, cash yields, investment decisions, and sensitivity analysis. Distinguish direct income statement effects from indirect effects on demand and market valuation. Question 16. Tell me about a time you found an error in financial analysis. During a university investment project, I noticed our projected revenue growth did not reconcile with the underlying unit assumptions. I traced the issue to a duplicated month in the source data, confirmed it independently, and explained the impact to the team without assigning blame. I corrected the model, added a monthly control check, and documented the data process. The experience reinforced that strong analysis requires both technical accuracy and the confidence to challenge results respectfully. Present a concise star example showing how you identified the issue, validated the underlying data, communicated professionally, corrected the analysis, and improved the process without blaming another person. Question 17. How do you prioritize competing deadlines from different stakeholders? I first clarify each request's decision deadline, business impact, required level of precision, and dependencies. I then sequence work around immovable deliverables, communicate realistic timelines, and provide an interim view when a full analysis cannot be completed immediately. For example, I might deliver a validated directional estimate first, followed by a deeper version. I keep assumptions visible, document changes, and escalate conflicts early rather than allowing an unexpected delay or rushed error. Be sure to mention urgency, business impact, dependencies, data availability, communication, milestone planning, and escalation. Show that you protect accuracy while remaining responsive and transparent about trade-offs. Question 18. Which Excel tools do you use most often for financial analysis? I regularly use Excel OOKUP or index match, SUMIFs, pivot tables, charts, conditional formatting, and data validation. For larger files, I use Power Query to clean and combine source data, then build a transparent output model. I separate inputs, calculations, and presentation, label units clearly, and include checks for missing values, duplicated records, and balance mismatches. I also use scenarios and sensitivities to show decision-makers how changes in key assumptions affect results. Discuss lookup functions, SUMIFs, pivot tables, charts, data validation, conditional formatting, scenario analysis, error checks, and potentially Power Query. Emphasize transparent, auditable models rather than complexity for its own sake. Question 19. How would you present an unfavorable variance to a senior manager? I would lead with the headline, "Actual operating expense was above budget by a defined amount and percentage." Then I would provide a concise bridge separating volume, rate, timing, and one-time factors, followed by the forecast implication. I would distinguish controllable issues from external pressures and recommend specific actions, such as revising staffing assumptions or reviewing vendor costs. I would keep backup detail available, but tailor the initial discussion to the decision the manager must make. Focus on a clear headline, quantified variance, root cause bridge, controllable versus external factors, forecast implications, recommended actions, and concise supporting detail tailored to the manager's decision needs. Question 20. What would you do if a manager asked you to make the forecast look better? I would clarify whether the manager wants a legitimate scenario analysis or an unsupported change. I am comfortable presenting an optimistic case, but I would label it clearly, document the assumptions, and retain a realistic base case. If asked to conceal an unfavorable fact or manipulate results, I would respectfully explain the risk, involve the appropriate finance leader or control function, and preserve supporting evidence. Credible analysis depends on accuracy, especially when leaders are making resource and investment decisions. In your answer, emphasize integrity, factual assumptions, documented scenarios, respectful challenge, escalation through appropriate channels, and the responsibility to protect decision quality and the company's reputation. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.